So we're here at the Finance COP, and curiously, for a gathering of governments, the credibility of almost all proposals on the table for the new climate finance goal depend on private finance. That's either by you being mobilized, so deals being de-risked by public or multilateral funds, or alone in order to fulfill this broader investment goal, the sort of second part of the onion that's on the table. But it's no given that private finance can or will step up. We've had a year of strong headwinds against sustainable investing, which has been topped off by the election of a new American president who's not supportive of the climate or multilateral agenda. So we're going to delve into all of this and what it means for boosting private finance to combat and adapt to climate change. If there's time, I'd like to do a Q&A at the end. So if you've got any questions as we speak, please submit them via the QR code that should be up on the screen, and it isn't, but hopefully will be soon. So the new climate finance target under negotiation here at COP29 estimates put the needs for developing countries in the trillions of dollars. And as I mentioned, the success of all options on the table depend on private finance. And that's been kind of framed here, or high on the topic, as blended finance. But this is still so small, and it's nowhere near meeting the needs. So Marisa, StanChart has got a big footprint across emerging markets. What do you see as needing to change to greater facilitate blended finance to achieve these ends?
Sure. So where capital hasn't flown in scale yet, although we are growing, so we've hit over $1 billion by your own research that just recently came out about just renewables investing anyway alone in emerging markets has hit now over $100 billion for the first time. But that is only 17% of overall climate finance. So what do we need? Where you see it moving the fastest, and I used a statistic again from your own research, which is sort of more than 400 times more finance will flow if you have good policies. That's the starting point, which is exactly why we're here. If private capital and finance can come together with a very directed ask about, say, refreshing NDCs, where these NDCs are very clear, they're very granular, they can speak to us about where the holes are, then we can respond. And one of the beauties of blended finance is, blended finance in some respects is responding to gaps in the market. So it's when private capital providers who are commercial actors say, I need to bring in some other form of capital to buy down the cost, because that's one of the biggest issues that we have in the emerging markets is affordability, then you're starting to bring it all together. So that's really what we need, and that's what we're here to try to negotiate. So I am hopeful because the scaling potential is massive in our markets, and it's bifurcated in some respects between, we say the global south, which is painting a very big part of the world with one brush, but when we see what's going on in middle income, high growth economies, the scaling is absolutely there. Take in India, for instance. I just have recently gotten back, and I was honestly somewhat shocked, even though intellectually I knew it was going on, to see just how quickly the proliferation of solar, by virtue of a policy from Minister Modi that said in very short order you're not going to be able to import solar components, so you're going to have to figure out how to make them. And all of a sudden, what happened? At the same time, we need the energy mix to completely change in our country. Boom. The capacity is there, the build is there, the scaling is there.
Yeah. Okay, so that's kind of the on-ramp to blended finance, but the use of public funds to de-risk private investment is also meant to have an off-ramp, right? Like it's meant to be a means to an end rather than an end in itself. So, Karen, are you seeing that happening? Are there examples of where blended finance is transitioning into private finance being able to invest on its own 2 feet in these markets? And if so, could you share some examples of where you've seen that take place?
Sure. I do think the off-ramp should be in the calculation and should be the goal. And when we, talking about India, when we actually went in to finance commercial industrial solar 6-7 years ago, and that was really sort of taking over from World Bank and IFC and National Reserve Bank of India, so there was a lot of policy, and they were publicly blending it with MDBs, multilateral development banks and development finance institutions. Once the scale has been reached, they were calling up, private sector banks, and we were one of them to actually go in and take over completely the financing. So that's actually working with a very large PE infrastructure portfolio company, and that's sort of the playbook we follow, right? We have to follow very, very successful portfolio companies taking over from traditional public finance or public MDB DFI blended finance into more private sector. So we've actually done that. We've done that in other geographies as well. I don't think it's happening as much as we all want to see, largely because I do think some of the risk factors are not all de-risked, right? Insurance sector has to come in and play a role because it's not just really government with technical assistance, with enabling policies, MDBs, maybe side by side, maybe de-risking. You really have to think about currency risk, you have to think about political risk, you have to think about technology risk. Although a lot of the deals we're seeing is in mature technologies, green hydrogen and e-fuels, and these things could be very helpful for emerging markets. We have to see that green premium coming down. And I think the insurance sector has a role to play. And so we do need more of these off-ramp preparation work being done across the board. But I am hopeful that will happen more and more.
Okay, and the point on the insurance sector, you mean they're the private insurance sector, you're not talking about public?
Exactly.
Risk. Yeah, okay.
But we're also working on some transactions where we've explicitly said credit support insurance. So how do we de-risk? And we've brought in the MDBs and other players. So it can be private, it can be public, but solving for very specific issues that are the unlocks for us to bring these deals together. And can I also point to one other thing that we definitely need to factor in when we're talking about very large scale, particularly holistic decarbonization scenarios? Often we find that you might have a project, you might have the financing lined up, but the actual capacity in country, particularly in the emerging markets, fundamentally just isn't there. It's people who literally are giving you the permits. You might have deals lined up, and that's your bottleneck. So everywhere it's a little bit different, so we've got to be quite deliberate about what we're solving for.
Yeah, okay. And I want to turn back now to the kind of macro context, we could call it. So we've just seen the election of Donald Trump as the new American president. André, JPMorgan's obviously a very big American bank. How are you looking at the elections in terms of what this means for climate finance, both within the US and overseas?
All right, easy question. Look, I think we're all just waiting to see. There's clearly actions that can be taken from executive orders, but I think if you actually look at a lot of where the investments from the Inflation Reduction Act have occurred, it is in some of the red states. So I think it's likely to be a mixed bag. Whether or not it's, I think one of my colleagues earlier said, is it a sledgehammer or a scalpel? I'm not sure which one is going to be at this stage. But certainly we've seen significant enough growth in certain areas, and certainly would like to see that continue. I think there will be some casualties. We know there's been question marks about the Republicans' appetite for government to make EV mandates. But then you look at Elon Musk being so close to the president, you wonder, is there a narrative there that might actually benefit EVs? So I think there's a broader question to be asked. I think if you look internationally, though, certainly our expectation is if we just look at the progress we've made against the targets that we've set from a net zero perspective, we've already seen fairly significant progress. We're about halfway through to our 2030 targets. It has occurred in the sectors we anticipated. The power sector and EVs, we thought initially were always going to be the easier sectors to see transition occurring. Think about renewables, think about battery EVs. Clearly there are some headwinds now. Some of the government mandates around EVs, certainly data centers in the US, although I'm glass half full on data centers because of the fact that it's the big tech companies with deep pockets who are the ones who have the demand, and they may actually invest in some of the solutions. So I think we're cautiously optimistic that actually this is not going to significantly derail the direction of travel. But time will tell. Certainly from a JPMorgan perspective, we are looking to deploy capital. We're advising a lot of clients. We're seeing appetite amongst clients to continue to transition. And fundamentally, if the economics make sense, then I think transition will occur.
Yeah. And this is the kind of question for both JPMorgan and Bank of America on the tax equity market. So this is using tax credits to invest in renewable energy infrastructure within the US. And I think it's around $20 billion. It's been a big market for both of you. Massively streamlined under the Inflation Reduction Act. Is that a market that you're concerned about in terms of under the new the new government getting money to renewable energy and the investability in particular for banks?
I think JPMorgan and Bank of America are for sure the top players in the tax equity market. And I think Inflation Reduction Act introduced 2 years ago, what it really kind of brought to the market is this transferability and direct pay. So in a way, sort of reduced our, let's say, market share, if you will. But that's a good thing because you have many, many Fortune 500 and other taxable tax-paying companies able to participate in the investment in the energy transition. And we both have done a lot in terms of sharing our know-how, sharing our diligence, sharing our investment expertise and track record with many corporates in the US, in the consumer product sector, in the technology sector, in defense sector, energy sector, to actually use their tax capacity to invest in the tax credit market. So tax equity has gone into more of a, transferable tax credit structuring market. There's direct pay as well. I mean, we're hopeful those will stay because you can't rely on a small group of banks and investors to carry the trillions of dollars needed, right, the burden to transition our economy. Whether you do that for commercial reasons or do that for climate reasons, it's good business. Good business is good business. So hopefully transferability will stay. As André alluded to, I think the credits so far, in the $500 billion investments that we saw, a lot are in Republican states. Pretty balanced, but more in the Republican states, and we see Congress kind of taking that up very favorably. Hopefully transferability, again, just introduces more investment dollars, not on taxpayer dollars, right? But kind of from corporates and others into the equation. So hopefully that will stay as well.
Yeah, okay. Would you like to add?
No, agreed.
On the last question on this topic, the overseas investment picture. So the US is a major shareholder in all of the big multilateral development banks, not just the World Bank, I was surprised to learn, but also the Asian Development Bank and others. And again, Trump has been kind of not so favorable towards the multilateral agenda. And what, in your view, does this mean in terms of the outlook for blended finance, in terms of getting money where it's needed to combat climate change?
Well, I mean, I'll take a stab. I think it's not just the multilaterals. I think you've got to look more broadly. We've certainly seen some of the projects in Europe that transition-related that have succeeded have had a variety of funding from the EU amongst other areas. So I think insurance is going to play a key role. Export credit agencies are going to have a role to play in this as well. Again, I'm interested in Marisa's view on this because ultimately, where a lot of the benefits could be, if you start looking at the multilaterals, is in the emerging market developed economies, who would like to see the multilaterals still play a significant enough role. So again, I'm not sure that you're going to see a significant scaling back or paring back of this. It feels to me like, depending on the sector, the geography, again, as long as the economics are making sense and there's momentum, as we're seeing in India in the solar sector, I think that's irreversible.
I would agree with that. And also, let's also remember that concessionary capital isn't only provided by multilateral development institutions. What we're starting to see, and there's a big presence here at COP, is the philanthropic sector. Pools of philanthropic capital coming together in a very directed way, saying, I want to be part of the energy transition. If catalytic capital is a feature that is needed in a particular structure, we're there. So that's pretty exciting development. The other thing I would say is that the level of engagement that we have from countries who are shareholders of these multilateral banks outside of the US is enormous. And a lot of this is in some respects self-interested. So if you're thinking about a developing market country who's a shareholder in an MDB, the net benefit is to their own country if they're participating. So I'm actually a big believer that if anybody starts to wobble, there's going to be plenty of capital that is there to try to fill in the gap, particularly in the EM world.
Okay.
If I may just add one thing, and I think challenges are always opportunities, right? When you think about, what we just talked about, again, insurance sector has a role to play, and clearly development finance institutions, a lot of governments are putting their DFIs on steroids. And you think about that. You think about the fact that clearly United States will remain as one of the largest foreign aid providers to the rest of the world. And you think about how you can use that funds or potentially thinking about restructuring some of those partnership, right? And given the geopolitical interests, given the energy security, energy affordability, energy transition agenda, maybe if transition isn't as high on the agenda, energy security and geopolitical interests are still very high on the agenda. So I do think partnerships are going to remain. I do think there are clever ways and perhaps more efficient ways of using foreign aid and other partnership dollars. DFIs, I mean, DFC has done a great job in the United States, and that mandate hopefully will stay. So I do think, value chain, supply chain, build up and security is a priority. And I do think we can actually, from the investment sector and financial services sector, our job is really to connect the dots and make sure money and capital goes where it needs to.
Yeah, okay. And I want to turn now to transition finance. So coal, the world's most polluting energy source, and yet still powers over a third of global electricity. Banks have been reticent, I think it's fair to say, across the board to get involved in the financing of the early phase out of coal power plants, linked, for example, to their climate policies and also, I think, regulatory sentiment. But both Bank of America and Standard Chartered have pitched to finance the shattering of a coal plant in Indonesia, Cirebon, and that deal was due to close in June, but we haven't heard a huge amount about it since. So I don't know, Marisa, perhaps you could tell me what's holding it up, and is there still a role to play for banks in the financing structure of these deals?
So whilst I can't comment on an ongoing transaction, and I can talk in the conceptual, for sure we have appetite to participate in early coal decommissioning. It's critical in our markets particularly. Our home is Asia, Africa, Middle East, and these are, in many cases, they're coal-dependent economies. And the only way we're going to get to our own net zero targets is if we help our countries and our clients in those countries transition. We went so far, and there was a lot of engagement, I have to tell you, with our external stakeholders to change. We have what we call position statements, and those govern what we will and won't do. And one of our position statements is no coal financing. However, all of this is nuanced, and when coal decommissioning opportunities came to the table, and we were having this conversation with the NGOs, who are generally the ones saying, we don't want you to be financing heavy industry or high carbon emitting industries. The way we had the conversation was, we want the same thing. And the only way, particularly in these markets where the coal plants are quite young in their life cycle, is if we decommission early, and isn't that a good thing for the world? And we got tremendous support, and we adjusted our position statement only for that very specific use case, and that set us on the path to start engaging in financing. And a lot of this isn't commercial at the traditional rates, and so these types of structures are the perfect examples of a blended finance opportunity. And let me touch on one more thing in terms of financial creativity, where we're bringing new models of finance and new ways of thinking to the table, and something as complicated as coal decommissioning is the carbon credits world. So with some very interesting engagement, particularly in Asia with Asian governments, and I give a lot of credit to the Singapore government, the Monetary Authority of Singapore, who's been really promoting this idea of creating a coal decommissioning carbon credit. This is not high tech. You don't have to worry about the integrity of the project, because you know very clearly if you shut down a plant what emissions you save. The math is quite simple. The concept of creating a credit around that and being able to sell that credit to help pay for that decommissioning, really interesting idea.
Yeah, okay. And André, JPMorgan, what is your appetite in this space? And I think we talked briefly about the UK Transition Finance Market Review that's just been undertaken. It's an example of recommendations to regulators about how they could possibly change to facilitate this. How are you looking at that, and what's your kind of appetite in this space?
I think similar with my colleagues. In fact, one of my colleagues in our risk team in the audience actually did exactly what StanChart has done, and helped us change our own policy framework to allow for some of these coal phase-out projects. I think there's also, it's interesting because there's the framing of it is the financed emissions, and I think our view on financed emissions is different from a few other institutions. We take an approach which is more about the intensity of our clients' operations versus absolute. And the problem when you start counting absolute is the issue you're asking the question about, which is the consequence is if you take exposure to this asset, it's going to increase the emissions that you're financing. And I think we need to move away from that. I mean, I think we need to understand the fact that these assets do need to be decommissioned. We're also looking at projects similar to Cirebon, and we certainly have the appetite. And I think to Marisa's point, the interesting thing about Cirebon is, again, you do have the multilateral angle to it. You do have concessionary, lower interest rate lending going into it, again, which is the way in which these projects are going to have to be done going forward.
Yeah. Okay. We've got a few minutes left. I just wanted to see if there were any questions from the audience. There are.
I have quite a few, so I'll see if I can get through a couple of them. I'll start with the coal. Regarding the coal phase-out credit, what is the money used for? Replacing the capacity, or happens if the financing gathered is not sufficient? Replacing capacity, or if the financing gathered is not sufficient.
Okay, I think that's one for Marisa.
Well, certainly some of the early ones we're working on is actually to pay the owners to shut the plant down early, because many of these plants are privately owned. And somebody's got to pay to close them because somebody paid to put them in place in the first instance. So that's sort of the first generation of these. They aren't state-owned businesses, so there is a private actor involved, and that private actor needs to be incented to shut down early. There's no other mechanism, otherwise it would keep going.
Yeah, I agree with Marisa. I think it's really for foregone future revenue of the plan, right? But I do think the second generation, if you will be actually for investing in replacement.
Yes.
And power generation, whether it's renewables, whether it's looking at geothermal, whether it's looking at hydrogen.
Yeah.
Will mandatory corporate transition plan disclosure help transition finance to flow?
André?
Short answer, I don't think so. I think, when we went into the transition finance market review, I think the view was what we need is transition plans, we need taxonomies, we need labels, and then transition capital will start flowing. And I think all of those are useful tools. It certainly would benefit us as a bank to have our clients disclosing their transition plans. But unless our clients actually have economically viable assets to invest in, capital is not going to flow. So I think we need to understand that mandatory transition plans, fine, may be good from a disclosure perspective. They're not necessarily going to unlock the capital that you need. I think a lot of what we've been discussing on this panel, government regulation, policy frameworks, blended capital, concessionary capital, that's what you need in order to allow some of the capital to flow into some of these solutions.
I can just comment, having just literally signed off on our 50-page transition plan document, which we're about to disclose as part of our annual review next year, that the document is helpful in the sense that it forces your institution, we're a very large, complex institution, to put into one place what is our plan. How are we executing it? How are we operationalizing it? So interestingly enough, the engagement to produce such a report was actually quite helpful for my own stakeholders inside my bank. And then I do think that some degree of transparency with our clients about how we're thinking about it and how we're approaching the transition is helpful. But I 100% agree with André in the sense that, is that going to be the be-all, end-all for the capital flow? No, it's getting into these projects, as the three of us do, rolling up our sleeves and trying to figure out how do we solve for those missing gaps we started at the outset of the panel.
Okay, I think we've probably got time for one.
One more? Okay. How do you see commercial banks' role in the buildup of industry awareness, capacity and capability? To your earlier point, Marisa, that this many times is lacking in emerging countries to enable blended financing deals to happen?
I think a lot of it is actually sharing the know-how, the expertise, right? All of us have gone into different partnerships, whether it's the JEP that we were part of, whether it's the B20, for Brazil's G20 this year, we were heavily involved in sharing know-how, with the United Nations. Again, a lot of us are involved in the United Nations Global Investors for Sustainable Development, SMI. So through these task forces, we're really sharing templates, right? How do you get a deal done? What is de-risking? How do you actually get some of these, blended deals done, and start looking at carbon credit deals, right? Project finance templates, warehouse facility, drawdown facility. These are things that are very common in OECD countries, and they're not emerging markets. So one is sharing expertise, sharing the financing templates, education, right, with governments and also private sectors within the geographies. Two is really around kind of demand signal, right, ourselves being actually kind of getting governments and getting other off-takers into the country, multinationals, to start actually facilitating transactions from a preparation standpoint, and so on and so forth. So a lot of things we could do.
Can I just add one quick one? Just a shout out for your audience. There's something called CASI, C-A-S-I, which was championed by Dr. Ma Zheng, who's a UN climate champion. The whole idea behind this was, as absolutely Karen said, is to share best practice and knowledge. So this is a resource that was designed to take the best of the best, no matter what education or subsegment of climate is out there, and put it into one place and make it available, particularly for the developing market. So if you are a young policymaker or you are a young person who's actually going to have to sign off on these permits, you can dip into this knowledge, this wealth of knowledge, and get yourself really up to speed on what those issues are that you need to do your job. So it's sort of a real capacity building initiative that's global in nature, and the system is contributing to this. It's quite exciting.
Great. Well, on that note, thanks very much, everybody. And I think, yeah, we need to wrap up there. So thank you very much to the panelists.
Thank you.